Hello, early birds. Thank you guys for joining us. We got a really exciting session scheduled for today. Let me just do a quick check on my audio. Hopefully I'm coming through loud and clear. Um, looks like it's good. Let me just double check that. Test microphone, test microphone, test microphone, 1, 2, 3. Awesome. And thank you guys for joining us today and taking time out of your lunch. Let me get this slideshow up and us launched on Facebook so we can kick off. Woohoo! We are now live. So let me get my screen up here and share my screen. Da, da, da. Awesome. Thank you guys for being patient. Today's session is going to be on the top 10 advanced tax strategies for corporations. Before we get started, I am just going to kick off with a bit of housekeeping. So if you are joining us live here on Zoom and you have some questions, please feel free to ask those questions by preferably using the Q&A functionality. I will be looking there first for any questions. Next, please raise your hand if you would like to be unmuted so you can ask a question live. And lastly, you can also use the chat. If you happen to be joining us live on Facebook and joining the session that way, you can post your questions into the comments and my colleague Jose will be transmitting those over to us here live in the Zoom meeting. So without further ado, I want to give you guys a bit of background on myself and our firm. My name is Andrew Wall. I'm the managing partner at CPA4IT. Our mission is to help our clients organize their finances, create wealth, and transform wealth into a legacy. We have been recognized as one of the top 50 cloud accountants in North America. We are an elite QuickBooks Pro advisor, which means we get some special discounts and pricing for those of you who like to use QuickBooks. And we have been specializing in service-based businesses, specifically the information technology and IT consulting market, since 1984, when my father, George Wall, founded the firm. We are also an ISO 9001 registered firm, which means we have systems and processes in place and that those are externally audited to make sure that we are striving for constant and never-ending improvement. So we are very much a systems and process-based company, again, all focused on helping you organize your finances, create wealth, and transform wealth into a legacy. Today's session, as I said, is going to be on the top 10 tax strategies, advanced tax strategies for corporation. The agenda we're going to be talking through today is the low corporate tax rate, income splitting, income smoothing, tax deferral, home and auto loans, insurance strategies, pension plans, the capital gains exemption, and lastly, holding companies. So again, if you guys have any questions on any of these sessions, please feel free to post them into the Q&A, and I'll do my best to address them as I see them. Now, for Canadian-controlled private corporations claiming the small business deduction here in Ontario, the net tax rate is only 12.2%. For other corporations, the corporate tax rate is actually 26.5% after the general tax reduction and federal tax abatement. Without that general tax reduction, the basic rate of Part 1 tax is actually 49.5%. So that 12.2% low corporate tax rate is a significant financial advantage. However, the small business limit in Canada, um, which is limited to $500,000 and can actually be eroded by investment income, is an amazing tool for allowing you to defer taxes and allow you to invest more money. So, the goal when we talk about helping our clients organize their finances, create wealth, and transform wealth into a legacy is we often look at the corporation as the vehicle for creating that legacy. The goal is to use your corporation as a tax-free a tax-deferred retirement vehicle. So the goal is, if you have savings, to be able to invest that within your corporation. And because you're only paying 12.2% in the corporation, that means you have basically 88 cents on every dollar to be able to potentially invest. And when we talk about investing and returns on investment, the more you can invest, the better your return, because that's going to compound or grow substantially faster than if you were only investing, say, 54 cents on the dollar if you were paying, or sorry, 46 cents on the dollar if you were paying that highest personal tax rate of 54%. So the first and most important tax strategy to use for a corporation is to take advantage of the low corporate tax rate. And the only way that you can do that is by leaving money inside of your corporation. So the goal, like I said, is to save money up and to invest it within your corporation. And once you're building up that nest egg, when we talk about creating wealth and transforming wealth into a legacy, we're going to move into some of these more advanced tax strategies like holding companies, which we will talk about later on down the road. But the first and most important step is to leverage the benefit of the low corporate tax rate. Now, I know some of you are wondering, should I be investing in my corporation or should I be investing in RSPs and TFSAs? And the good news is we have a whole webinar dedicated to that. You can go watch it on our YouTube channel, or you can stay tuned because we will be launching it again in the new year, closer to the RSP deadlines. But there are some advantages of investing in your corporation over an RSP, which we get into in greater detail when we talk about the different um, savings vehicles and why you might want to use your corporation as your preferred saving vehicle. So the other thing we want to talk about is tax deferral. So net income of a sole proprietorship or a partnership is taxed directly in the hands of the owner. However, a corporation is a separate taxpayer with its own income tax rates. So a corporation which is incorporated in Canada is and is a CCPC. Um, um, these are eligible. This status allows them to claim that small business deduction, which we talked about before. Um, and the tax advantage that you can use with this is a shareholder with a corporation with active business income will have the ability to defer the payment of some income tax. And a corporation eligible for that small business deduction tax, as we said, pays tax on its first $500,000 of only 12.2%. And while the percentages of tax does differ, from province to province, that remaining tax, which is paid within the corporation by the shareholders, is deferred until the end of the corporate year end. As well, if you choose to do dividends and you're taking that money out of the corporation, that's actually deferred even until you file your personal tax returns. And with a corporation, you have the ability to declare salaries and dividends in your corporation anytime throughout the calendar year. So if you have a year end, let's say July 31st, and you declare a dividend on July 31st, you're not going to pay that tax on that income on July 31st. You're not even going to pay that tax 3 months after, which will be the interest-free period for your corporation's tax. You're going to pay the tax on that down the road when you file your personal tax return in April of the following year. Now, with a salary, it's slightly different. The CRA does certainly expect you to pay withholding taxes or source deductions to them whenever you pay employees. But another tax deferral strategy that you have within the corporation is to declare a salary as a bonus up to 6 months from the date of your corporation. And while we said you can declare a salary anytime throughout that calendar year, with the bonus, you're actually able to declare it, like we said, up to 6 months from the year end. And if you had a July 31st year end, that means that salary is actually going to be declared in January of the following year. So you won't actually have to pay taxes on that until February of the following year. It also means not only are you deferring when the taxes are going to be paid, you're deferring in which calendar year you personally are claiming the income from that corporation. And that gives us the ability to smooth income, which we'll talk about more in some of the next and upcoming sections. But one of the other things that you can do with a corporation is income splitting. And some of you might have heard about the new rules on dividend income splitting, which is otherwise referred to as TOSI, or tax on split income. And there are three areas that most small business owners should pay attention to when it comes to TOSI, or tax on split income. So with adult income splitting, if you are incorporated and dividend income is split with your spouse must work 20 hours or more per week during the last tax year or any 5 years in order for that split income to be excluded from the TOSI rules. If it is not excluded from the TOSI rules, there's basically a punitive tax that's going to make it not very effective. You can still declare the dividends, but they're going to be basically taxed at the highest tax rate. You should also be aware that a payment will be considered a reasonable return based on the following criteria: that the work performed supports the related business, that the property contributed directly or indirectly is in support of the related businesses, that the risks assumed in respect of the related business, and that the total amounts paid or payable by any person or partnership to or for the benefit of the individual in respect of the related business. And there are, of course, other factors that could be relevant. So if you are looking to do income splitting through the use of dividends, please make sure that you have a conversation with your account manager or your accountant before you do so, because these TOSI rules can have adverse impacts on you. In addition, if you do have adult children in the age range of 18 to 24, generally speaking, the split income in excess of a reasonable return based on contributions of these adult children will be subject to these TOSI rules. And this essentially means you can no longer reasonably pay dividends to adult children aged 18 to 24. So a spouse has to be actively involved. Children 18 to 24 is basically off the table. However, there is a small glimmer of hope. And for individuals age 65 or over, amounts received by that individual spouse will not be subject to TOSI if the amount would have been excluded, an excluded amount if included in the individual's income. So basically, if you're over 65, you can still do income splitting with your spouse through the form of dividends. So again, if we're using that vehicle as a retirement vehicle, building up money within your corporation that you're going to use in retirement, once you hit 65, you can once again do dividend income splitting with your spouse. However, even if you're not doing dividend income splitting, you can still do salary income splitting with your children. Now, there is a reasonableness rule and requirement, and the reality is that that reasonableness rule is a bit subjective. What is reasonable for the work provided is, like I said, a little bit subjective. And it is certainly, there are ways to justify children's involvement with things like social media, or helping put together websites, or organizing your books, or filing documents. There's a whole slew of things that your children can help with, even if they are remote and away at school, where we can justify income splitting. And the reason that income splitting is so important is because of the way the personal tax system works here in Canada. No matter what province you're in, we have a marginal tax system, which means it's tiered, right? Now, you never pay a new tax rate on the income in the lower tiers, but as you move into a new tier or a new tax bracket, the percentage of tax that you're going to pay on that income goes up for that tax bracket. And what that basically means is if you have one individual earning $100,000, that's less than two individuals, one earning 70 and one earning 30. That situation where you have two individuals, and in fact, the more individuals that you're splitting that income with, the lower the overall tax. And there's also even a basic exemption, a certain amount of income that you get tax-free, that is indexed to inflation and does change year over year. So if you're looking at doing some income splitting with your children, if it's below a certain threshold, they may pay CPP only and no tax on that at all. And with your spouse, they're probably going to be able to get that entire low or basic exemption, as well as have the remainder of the income in the lowest personal tax bracket, even if they are just your financial partner and confidant that you make business decisions with, even if they're not meeting that 20-hour criteria that is set out for dividend income splitting. Now, the other thing we want to talk about is income smoothing. And income smoothing is a bit of an umbrella term for various techniques and methods used by accountants and financial experts for controlling or hedging the effects of high rises and sharp falls in corporate income. So, as this is a commonly used income smoothing technique, and it's often, associated with sort of clever manipulations of income or profit and creative techniques um, for moving income from one period to another. However, the real practice of income smoothing goes beyond these sort of high level things, and it encompasses all the strategies in understanding your personal income, your family members' personal income, and all these income splitting opportunities that we're going to do, as well as the corporate income that we're going to have. So again, this gives us the ability to smooth income over years. And again, much like we talked about income splitting, where if we have more people to smooth and split income amongst, if we have more years to smooth income, we can avoid those higher bands. And again, so if we had a year of $100,000 one year and $50,000 the next year in personal income, if we actually had 2 years of $75,000, we'd pay lower tax. So that ability to smooth income can really substantially reduce the amount of tax that you pay. And with IT consultants who may be on contract with a set hourly rate, this may not be as critical. But with companies like in the real estate industry, where they're high commission and there is quite a large variation in the income, this can become a very, very important tool for reducing tax. Now, another important tool for reducing tax is the ability to use home and auto loans, which are a very specific type of employee loan. There are also shareholder loans, which are a little bit different, but home and auto loans are available to employees. They do need to be available for all employees of the corporation. Typically speaking, you're usually the only employees, or your family members are usually the only employees for our typical type of clients. So that's not usually so much of an issue. These home and auto loans do bear a prescribed interest rate and prescribed terms by CRA. Typically for a home, you might find 25 years, and for a car, maybe 7 years. So this means the money does have to be repaid within those terms. And in addition, the corporation does need to charge interest, and that interest does need to show up as a taxable benefit to the employee, and it goes on their T4. And you do have to repay this loan, you're paying it back from yourself to yourself. So it's a little bit of left pocket, right pocket. But that interest is a taxable benefit, as we said, so that the real cost here of doing a home or an auto loan is the tax on that interest. Because it's a percentage on a percentage, we're now down to basis points. So the cost is very, very small to be able to do this. And what the advantage of doing a home or an auto loan is that if you weren't using a home or an auto loan and you wanted to take out, say, $100,000 to put as a down payment on a home, you would normally have to take that into personal income and pay personal tax at whatever your marginal tax rate is. And then, you would be left with maybe, a much, much smaller percentage, as potentially as little as 46 cents on the dollar that you'd be able to put towards the down payment on that home. Whereas if we take it out as a home loan, you're able to take out the full amount without being taxed on it in the year in which you take it out. Now, as we did mention, you do need to repay that loan. Typically, how that loan is repaid, as opposed to you putting the money back into the corporation, typically that's repaid with a deemed repayment by declaring that as a director's advance, which would then becomes salary to you. So let's say that you took out $100,000. Instead of that being $100,000 taxable in year one, you're going to have $4,000 of income for the next 25 years, which, as we talked about earlier, when we can smooth income over longer periods of time and we can avoid those higher tax brackets, we can lower the overall tax that you will pay within your corporation. So these home and auto loans can be very, very effective strategies. I know there's lots of information out there. People telling you you can't do that. We've been in this business for quite a long time. And what I can tell you is it has to be very clearly documented. You have to make sure that you're doing things properly because they can be denied if they're not structured properly. And if they're not structured properly and they are denied, then all that income is going to become income to you personally and taxable at whatever your marginal tax rate is. So if you are considering doing a home and auto loan, this is not something to use the Google accountant for. You really need to work with a knowledgeable professional accountant who's familiar with the process and can help you structure it properly. The other thing we want to talk to you about are insurance strategies. So there are a whole bunch of different types of insurance strategies that can be used within a corporation. And typically the reason accountants like insurance strategies so much is because they are very, very tax effective. And when I talk about insurance strategies, I'm usually talking about some form of whole life insurance policy. I'm not personally a fan of term life insurance policy, which often by the time your renewal rate comes up, your renewal period comes up, the renewal rate is so high that you don't renew it, and you typically haven't made a claim, and so that's money that's just gone out the window. But with whole life policies, you're actually building up an investment that actually has a redeemable value, even if you don't ever make a claim on that benefit plan. Plus, what we as accountants really like about insurance policies within the corporation is that when an insurance policy pays out, it pays out through the use of a capital dividend account. So the corporation will receive a benefit, and that benefit is now eligible as a capital dividend, which can be paid out to shareholders of the corporation completely tax free. And that's the big win is you're able to put money inside of the insurance policy. And when you talk about creating generational wealth or transforming wealth into a legacy, being able to transfer this wealth to your children very, very tax efficiently is the number one reason that we like insurance strategies. Now, the one thing to mention about insurance is obviously there's different types of insurance. We've got, the life insurance, which we've talked about here. There's also liability insurance, as well as things like error and omission, health and dental. Health and dental and errors and omissions are 100% deductible. There's no real issues there. Liability, if you do have liability insurance, you can deduct it, but if you deduct it, the benefits become taxable. So often we don't recommend that clients deduct disability insurance. Now with life insurance is a little bit different, and the corporation does have to be set up as the beneficiary. In addition, it is one of the things that is specifically disallowed unless there is a bank covenant requiring it. However, if the corporation is set up as the beneficiary, we get the advantage of that CDA account. Plus, while it's specifically disallowed and you're not able to deduct it as a business expense, what you are getting is the ability to pay for that insurance policy or contribute into that insurance policy at money that's been taxed at that corporate tax rate of 12.2% as opposed to whatever your personal tax rate is, which is why corporate life insurance policies, in my opinion, supersede personal life insurance policies. There is one other special type of insurance maneuver, which is really saved exclusively for those people who have created a large amount of wealth inside their corporation and are looking to get access to that money immediately. So there is something that we often refer to as the ICE maneuver. Once upon a time, there used to be a program that they called it the 10-8 maneuver, which is now disallowed by the CRA. It used to be called the 10-8 because the structure had a guaranteed rate of return of 10% and a cost of borrowing of 8%, so guaranteed return of 2%. But the government didn't like that, and so they did not allow you to tie the rate of return against the cost of borrowing. And you're probably wondering, what are you talking about, rate of return and cost of borrowing? How does this ICE maneuver work? And I'll give you the layman's term, but again, if you're interested, we would have to introduce you to insurance specialists and actuaries who specialize in this. It's not a product that we sell, but again, it is a very useful tax strategy for a very specific type of clientele. And what happens is you work with this insurance broker who has a relationship with the bank. The bank will lend you a set amount of money, let's call it $500,000. They will lend it to you personally. You will then take that $500,000, deposit it into your corporation, creating a debt that the corporation owes you. So it now owes you back that $500,000, right? Because you've lent it to the corporation. The corporation then buys a life insurance policy that is used as collateral for the loan that lent you the money. Sometimes in the early years, depending upon the value of the life insurance policy, the bank may require some additional collateral, but that insurance product will be used as collateral for the loan. Then as the loan continues to accrue interest, and there are fees for the life insurance policy, these are all actually paid out of the growth of the life insurance policy, or accrued out of the value of the life insurance policy. At the end of when someone would receive a benefit from this life insurance policy, the corporation receives the benefit. It's paid out as a capital dividend, which we talked about as tax-free. It then goes to pay off the loan, sometimes with a nice extra bonus. But the real benefit of that insurance policy isn't necessarily to give you money. It's that it created this loan, right? You put that money into the corporation that was lent to you personally by the bank, and that now frees up your ability to take $500,000 that you might have in cash or stocks or other investments, and you can now take that out of your corporation as a repayment of your loan to be used for whatever you would like to do. And so this is, like I said, a very, very effective tax strategy for getting money out of your corporation immediately, tax-free. Now, it's not without risk and it's not without cost. It's just basically that cost is deferred until the life insurance policy vests and then is paid off by the benefits of the life insurance policy. And where the risk is because those rates of return are no longer tied together, your cost of borrowing could grow faster than your rate of return on the life insurance policy, which is an investment. So these aren't without risk and they aren't without costs, but they are very, very useful strategies for those who have a very specific need to get money out of their corporation immediately without wanting to pay, large personal tax rates. Whew, sorry, I got a mouthful. I'm going really quick here because I want to make sure I can leave some time for Q&A, which I do see some questions are already popping up. Maybe we'll take a minute and a breather to address that question that has already come up. You have to leave for a client meeting before the meeting ends. Will the recording be available afterwards? Yes, the recording is, we are airing this live on Facebook, so you can go back to our Facebook page and you will find it there. And in a week or two, it will also be uploaded to our YouTube channel where you will find it as well. So these, in addition, we've done this session before, so you can find it, past recordings as well. And that's why we do go live on Facebook, so that if anyone needs to leave or is unable to log in the Zoom for technical issues, you can always get access to the content that we're doing for you. Okay. So now we can jump back into pension plans. So there are a couple different types of pension plans that you can set up within your corporation. There's a PPP, personal pension plan, and an IPP, which is an individual pension plan. And the easiest way to explain a pension plan in layman's terms is it's like RRSP on steroids. So it does actually use your RRSP room to be able to contribute to a pension plan. So if you're using a pension plan, you're not usually using, an RRSP as well, because it does use up your RRSP contribution room. However, you will get more room with an IPP than you get inside of an RRSP. So if you are the type of person who's saving more than you could possibly contribute to the maximum amount of an RRSP each year, an IPP is going to be a really useful plan. In addition, an IPP is also going to be a really useful plan because these investments are protected. They are creditor proof, even from CRA. So, one of the big issues that we face in the information technology space is the risk of personal service business, where you might be assessed to be an employee, but for the corporation, you would be reasonably regarded as an employee instead of an independent contractor. Then the CRA will come along and charge a punitive tax rate on your income within the corporation. You won't get that 12.2%, and they'll deny a whole bunch of expenses. One of the expenses they cannot deduct is an IPP, or they cannot remove is an IPP contribution. So they are protected, so CRA can't come after them. And even if you are deemed to be a PSB, which our clients aren't because we adequately defend them, but if you, God forbid, were, the money that you put into your pension plan is protected and is a legitimate deduction. So basically what happens is you make a contribution to your pension plan. That's an expense to the corporation. The corporation is making a contribution to the pension plan, which is a deductible business expense, reduces the taxable income of the corporation. And like I said, it's going to be like an RRSP in that it is a tax deferral strategy. And so what will happen is in retirement, you will pull the funds out of your pension plan and you will be taxed at that point on the funds you withdraw from your individual pension plan. And the value of an individual pension plan, an IPP versus a PPP, is it's actually able to merge the pros and cons of a defined benefit and defined contribution type of benefit plan. So this is basically able to go back and forth between the two methods to get you the maximum benefit. As we said before, again, the IPP is going to give you even greater room for being able to contribute. So you'll have more ability to contribute to an IPP or a PPP than you would have into an RRSP. So this is a great way of sheltering and protecting money, as well as deferring tax that you will pay. Because like I said, becomes an expense deduction to the corporation, which produces the taxable income today and doesn't become taxable to you until you withdraw the funds from the pension in retirement. And of course, it's also going to be eligible for pension income splitting down the road when you do take the money into income, which is going to be another advantage for you. Sorry, I'm going to freeze here. Next, we want to talk about the capital gains exemption. And some of you may not be aware, but if you sell shares of a qualifying Canadian business, and this is, I apologize, this is a little out of date, but the lifetime capital gains exemption last time I checked was $883,000, $384,000. I think it's changed for 2022. I believe that's the 2021 rate. It is indexed to inflation, so it does change each year. But you're able to basically get a lifetime capital gains exemption for just over $800,000, just short of $900,000. And that's a tremendous value if you're able to do that. However, there are two main rules regarding the ownership of the shares and the use of assets of the corporation that in order to be eligible for the lifetime capital gains exemption. So first, throughout the 24 months immediately preceding the disposition of the shares must not have been owned by anyone other than the individual or the person or partnership related to the individuals. And the shares may be newly issued shares that have not been owned for a full 24 months, but they must not have been owned by an unrelated person or partnership in that time. So if you're thinking about doing some restructuring and then selling your shares, you need some time to be able to do that before they'd be eligible for the lifetime capital gains exemption. And in addition, throughout the 24 months immediately preceding the disposition of shares, more than 50% of the fair market value of the assets of the corporation must have been used principally in the active business carried on primarily in Canada by the corporation or the corporation related to it. So this is an act that sometimes, at the time of disposition, the shares are all or substantially all, which is 90% of CRA's definition of substantially all of the fair market value of the assets must have been used in the active business income. So at the time of selling the business, 90% of the assets have to be used for active business income. what that means is that if you have all your money inside of your company that you are attempting to sell, and you're also investing that in life insurance policies, IPPs, stocks, mutual funds, whatever you want, which you could do, you may inadvertently be impacting your ability to sell your shares and get this capital gains exemption. Now, if you're selling your business and you are selling shares, you can potentially qualify for this. However, one thing that's important to note is that many business owners or people looking to acquire a business don't like to buy shares of a business, because when they buy shares of the business, they are owning that entity and they are taking with it all the legal responsibility for past, present, and future for that corporation, which is why typically people who are acquiring a business prefer to buy assets rather than shares. And if you're selling assets, it's not going to qualify for this lifetime capital gains exemption. So it's important to be aware of that. But selling a business is very much a negotiation. And if there is a large potential upside for you, if you're selling your business for more than $900,000 and you have the ability to get a large chunk of it capital gains exempt, which means you won't pay any capital gains on that first, 800 and what did I say, $883,000. That can be a substantial benefit, and you might discount the price if they buy shares versus if they buy assets. So important thing to know and consider. But again, if you are selling the business for more than $900,000, you will pay the capital gains on the difference between, of course, your selling price and your cost base, which for most people is probably going to be zero or very little, and less, of course, that lifetime capital gains exemption. So that's a windfall and a lot to take in. For those of you who are considering selling your business, this is something that you need to think about. Like I said, at least 2 years before you sell your business, you need to look at potentially purifying your corporation and getting everything structured properly and making sure that you've got as many shareholders as is appropriate, so you can multiply that lifetime capital gains exemption if, for example, you're selling the business for more than $900,000. If you have multiple shareholders, you have potentially multiple lifetime capital gains exemptions to leverage. Again, come speak with your accountant or financial professional if this is something you are considering. And like I said, this is if you are planning to sell a business, you need to be making a plan, and a long-term plan that is typically about 2 years or more out. So the last thing to talk about is holding companies. So a holding company is usually an entity which is created for the purpose of gathering various assets, such as real estate, shares of other companies, assets, and sometimes considered an umbrella corporation. And in most of our client situation, the reason that we would set up a holding company is not so much for the purification, which we talked about in the lifetime capital gains exemption, because unfortunately, many IT consultants, you have what we call a lifestyle business, which means when you stop working, the business stops generating income and has very little resale value on the market. However, there are still benefits of holding companies, even if you're not looking to purify your corporation. And the benefits of a holding company are that investment income, or what they call passive income in Canada, is taxed at a higher rate. Remember at the very beginning, we talked about 12.2%, but 26.8 and up to over 50%, depending upon the types of income that you have. Investment income isn't going to be eligible for that small business deduction. And investment income, there's different types of investment income, but it's all going to be taxed substantially higher than that operating income. And if you have this all intermingled into one corporation, then what CRA is going to do is they'll say, yeah, you can have expenses that reduce the taxable income, but it's going to reduce the taxable income of the operating business first. And once you've eroded all the operating income, then it will begin to erode the passive income. And by setting up a holding company and structuring it so that it holds all the investments, it has all the investment income, you can be a little bit more strategic about which investments are in which corporation. And when you talk about declaring your own salary, which is usually one of your largest expenses, this gives you the ability to declare salary from your holding company to the point where you wipe the income of the holding company down to zero so that you're not paying that highest personal tax rate. And yes, you're taking less income from your operating company, and the profits of that operating company are therefore going up, but it's at a lower tax rate. The only downside of setting up these holding companies is that there is a cost to setting it up and there is a cost to maintaining it because it's, again, another separate legal entity. And of course, how you structure that holding company and operating company is very important. If you are a typical IT consultant of ours, we've probably structured, if we've done your corporation with the goal that eventually it will actually become a holding company, and that you will then eventually incorporate a new operating company, and the shares of that new company will be owned by the holding company. The only downside to doing it this structure the way we do it is that you need to change your contract with your end client to the new company, but it does save you substantially in legal costs. Whereas if you wanted to change your existing, you wanted to maintain your existing operating company as the operating company and move all the assets to another holding company, that is possible. But you have to do these rollovers, which require lawyers and tax lawyers, which have costs associated with them. So it can be done if, for whatever reason, you cannot change your contract. But typically, we've structured things so that your existing operating company can effectively become a holding company when you incorporate a new operating company. And like I said, if you've got investment income and you're generating more than about $20,000 of passive income, you're probably going to save enough in tax savings to justify that additional cost. But if you don't have that level of passive income, you will get some asset protection and some benefits from a holding company, but they may be outweighed by the actual financial cost. Oh, and with that, that sort of brings us to the end of our slide. If you have more questions, please feel free to reach out to us. I'm going to open it up for a bit of Q&A now. I can see that we do have some questions that have already come in live, so I'm going to go over to those and start answering those now. But again, if you've got more questions, please feel free to drop them in the chat. And thank you guys for joining us today. Okay. Ken, I'm glad this was useful, a great overview for you. Matt, you're asking, what do folks do when they begin to build large amounts of passive income in their corp due to the low corporate tax rates with nothing to write off against the income, i.e. rental income, private loans, etc. And again, this is when we talk about setting up those holding companies and making sure that that investment income is inside those holding companies. And depending on how much the investment income is, if it's more than $50,000, it could potentially begin to erode the small business deduction. And it's based on related companies too. So setting up the holding company doesn't take away that new rule that the lovely liberals gave us that basically says, hey, if you've got more than $50,000 of passive income, anything over $50,000, we're going to multiply that by 5 and take away that much money in your small business deduction limit. But it's based on $50,000 net income. So typically the first thing that you can write off inside of a holding company is things like salary, as well as things like IPPs, as well as things like a home office, telephone, internet. So there are some expenses that you can have inside this holding company that are reasonable and would help that business to earn income. And that is the criteria. One, as far as what you can deduct in a business, is it can't be specifically disallowed by the Income Tax Act. It has to be reasonable. It has to help your business earn income. Reasonable and helping your business earn income are subjective and open to interpretation. And we definitely want to help you to interpret that as aggressively as you can without crossing the line. So hopefully that helps. Sorry about this. I shouldn't have had this. We got another question here. Is the rate charged when you take out the IPP versus the RRSP equivalent, or is it higher? No, it's equivalent. It's going to be your marginal tax rate, or whatever your marginal tax rate is. So an RRSP and an IPP, like I said, they work very, very, very similarly. The money goes in. It's not taxed until you take the money out. But when you take the money out, it's taxed at whatever your marginal tax rate is. So again, I'm not necessarily an IPP expert. I have the accountant's understanding of it. If you are interested in learning more about IPPs, I would be happy to introduce you to a gentleman. And we do have a past webinar, if you go to our YouTube channel, that we have done specifically on IPPs. And the gentleman that we brought on is a true expert. He is actually the creator of the IPP. Before the IPP, there was only the PPP, personal pension plan. So he actually created that concept of being able to move between defined benefit and defined contribution, which is amazing. But hopefully that answers your question. And believe it or not, that is the last question that I have. So if there's no further questions, I'm going to thank everyone for joining in on our session today, and encourage you to keep coming back as we deliver more content in these webinars that we do on a regular basis. And of course, if you have any questions that we haven't addressed here, please feel free to reach out directly to your account manager, or if you're not an existing client, please book a free consultation with my colleague, Rachel Stedman, which you can do by emailing customerservice@cpa4it.ca, or by going directly to our website, cpa4it.ca, and clicking and booking a free consultation using the link free consultation. Thank you again, and have a great Tuesday. Bye for now, everybody.